The top 1% already pay more. Why tax fairness isn't about simple rates. The debate over tax fairness often centers on the idea that the wealthiest Americans aren't paying their fair share. However, a closer look at the numbers reveals a surprising reality. The top 1% already pays a higher effective income tax rate than most other Americans. Simply leveling the playing field by matching their rate to the lower 75% wouldn't increase revenue. It would actually reduce it. The current tax landscape currently, the top 1% of U.S. taxpayers pay around 26% of their income in federal taxes after deductions and credits. Meanwhile, the lower 75% pay between 10% and 15%, with the bottom half paying as little as 3–4%. In 2022, the top 1% contributed roughly $860 billion to the IRS, representing 40% of all individual income tax revenue. Why matching rates misses the point? If the top 1% were forced to match the lower 75% at a 15% or 18% rate, federal tax revenue would fall substantially. This is counterintuitive to most public perceptions about tax fairness, but it's a direct result of how income is currently taxed. The core issue isn't the rate itself, but what is being taxed. The capital gains disconnect the real frustration driving the tax. The rich sentiment lies in the differing treatment of income types. Wealthy individuals primarily accumulate wealth through investments, which are taxed at lower rates than wages. This disparity means an investor pays less on stock gains than a worker pays on their salary. Closing these loopholes and taxing investment income similarly to wages could generate hundreds of billions, potentially exceeding $1 trillion per year, according to economic estimates. This is a far more substantial revenue source than simply adjusting income tax rates. The unpredictability of behavioral changes predicting the exact impact of tax changes is difficult. Individuals respond to incentives, and the wealthy have the means to adjust their financial behavior. Higher taxes could lead to increased deductions, capital shifts, or even emigration, all of which would reduce taxable income. Economists disagree on how much income would be affected, making revenue projections uncertain. A deeper look at fairness, the most crucial takeaway is that tax fairness isn't about matching percentages. The top 1% is already paying a higher effective income tax rate. The real problem lies in structural inequities. Preferential treatment of capital gains, substantial estate tax exemptions, and exclusive access to wealth-preserving strategies unavailable to average workers. The conversation surrounding taxing the rich usually means closing these loopholes, not merely adjusting income tax percentages. The path to greater revenue isn't simply about tweaking rates, it's about fundamentally changing how wealth is taxed. This is a more complex task than just adjusting percentages, but it's where the real opportunity lies.